All right, all things are not equal when it comes to housing. Not convinced? Just compare foreclosure rates in places like Las Vegas or Orlando to what you see in New York City, and you'll see what we're talking about. So where are the hottest housing markets right now? CNBC's Diana Olick joins us from Washington with an exclusive look at just that. Diana.
Well, Melissa, we're talking about investing, of course, this morning. And just this morning on the front page of the Washington Post, it says rents in this area are up 22% in just the last decade. Why? Well, because a lot of people have chosen not to buy, and a lot of houses that used to be owner-occupied are now rentals. These are big single-family homes going for high prices. So it provides a great investing opportunity if you're willing to buy, hold, and rent it out. So we decided to take a unique look at which are the best markets to go, because it's all local. So we'll look at the best bets and, of course, the worst. With the help of Zillow.com, we're using 5 metrics to judge local investment markets. 1, price to income, which is most important. Areas where buying is a better value than renting, where home value declines are moderating, foreclosures are falling, but foreclosure sales are still big enough chunk of the market to offer some good buys. Many of the winners are actually in California.
And when you look at markets like Stockton and Merced, those are markets which have just been extremely hard hit. Values are down more than 60% from their peak, and foreclosure rates are very high. That said, by the price income metrics in terms of affordability, they've actually overcorrected somewhat. They're below historical affordability levels, and foreclosure rates are starting to come down in those markets.
And then there are some big surprise winners. Markets like Hartford, Connecticut, and Pittsburgh, which have returned to good levels of affordability where they were before the housing boom. They also have a decent amount of foreclosures, but not so high that they're pushing prices too far down. So you still got positive appreciation trends. Now, to the worst investment markets. They also seem mostly in the West, like San Francisco, Seattle, Portland, Oregon, where affordability is still challenging, and even Philly and Baltimore, where although foreclosures are not rampant, home prices are still too high and still falling. Now remember, we are talking about a specific set of investors, not flippers, but those willing to hold and rent out for that rental income. They're not using mortgages. It's going to be all cash for the best bets. Back to you, Melissa.
Drilling down on some very important details there, Diana. Always important when you're looking at real estate. Thank you so much. So with rising mortgage rates, is now the time to buy into these hot housing areas, or are prices headed even lower in 2011? Joining us now is Olick, Charfen, CEO of Distressed Property Institute, also Shari Olefson, an attorney at Fowler, White & Boggs. Thanks to both of you for joining us. Shari, what do you think? I mean, when you look at markets where, for example, the price-to-rent ratio is in favor of the buyer, kind of may make sense to jump in, right?
Yeah, the answer is both. Their prices will probably still go down a little bit across the U.S., but now's an excellent time to invest. And every time we read these headlines, Melissa, every time we see that, Bank of America's just written down another $500 million in home mortgages, that sounds like bad news, but it's an excellent opportunity because they've already taken the loss, it's out of the closet, and those properties can be purchased by someone for a good price. But it depends on your personal circumstances.
Well, Alex,
because as Diana pointed out,
go ahead, Shari.
Yeah, you have to be willing to hold. These rental opportunities, I mean, Diana's been telling viewers for a long time that there's a huge opportunity in rentals.
Well, Alex, let me just ask you, I mean, when you're looking to get into the housing market these days, what should your realistic expectation of upside be? If you say, okay, I'm going to hold that home for 7 years, can you really anticipate that you're going to see much opportunity in those 7 years, or should you just say, okay, if I can stay a little ahead of inflation, I've done well?
You should absolutely anticipate that you can stay ahead of inflation by a long shot. Here's how it works. In real estate, you make your money on the buy. When you're purchasing the property, you should be able to project what current rental rates are, what your cash-on-cash return will be, and what your return on investment will be. We're buying properties, my wife and I are closing on everything we can. We're buying properties where cash-on-cash returns are in the double digits on 100% cash-down long-term hold properties.
Where are you buying?
We're buying in Austin, Las Vegas, Phoenix, Arizona, and Florida. And when you look at these markets, in almost every major metro, within 20 or 50 miles of where someone lives, there are properties that are cash flowing. When we're in a sane market, properties cash flow, and it's a somewhat recession-resistant investment. Here's what I mean by that. Rental rates have actually increased as property values have decreased. That's on single-family homes, not apartment complexes. So as we see rental rates increase when property values decrease, that would indicate that your cash flow actually goes up. So not only are you staying ahead of inflation, in a recessionary housing market, you may be even getting further ahead.
Shari, there are a lot of things that Alex just said that made me nervous. Do you agree with him?
Those trends will continue. The trends in terms of the demand will continue as rates go up and more buyers find it more difficult to qualify for home loans. But there are also other opportunities, too, in commercial, for example. In my practice, I represent banks taking back all kinds of commercial properties. There are opportunities now to purchase airports and office buildings and hotels. And the other thing to watch for is the loss share agreements. Those banks that were taken over by the FDIC in the last 2 years, and there are over 150 of them, have agreements with the FDIC to share those losses. Opportunity for investors.
You know,
also,
Shari,
no purchases.
Do you worry at all about the high-end market? There's an article in today's Wall Street Journal talking about a drag on prices on Park Avenue, and they actually point to one apartment, and this is just an interesting little factoid, so I'll share it with you guys. William F. Buckley's apartment, it had gone on the market for $24.5 million in the spring of 2008, and apparently it just sold last week for $8.75 million. So, you know, significant downside there. It's still a heck of a lot of money, but it's a big fall from $25 million, Shari. Is this symptomatic of luxury real estate?
Yeah, I think there will be some impact in the high-end market in the coming year. And this, you know, everything that we're talking about is against a backdrop of a $1.7 trillion value loss in real estate over the past year. So there's no question that this is a risky business, and it's something that you really do need to do your homework. But the point is that once someone else has taken that hit, and once that hit is out in the open, it is an opportunity for gain for the next person. And you know what? The fact is we've whittled our way through and exposed a lot of the surprises that have caused the problems in real estate. So now I think the main issue is going to be a problem of working through this inventory.
Yeah, looking for the properties where the loss has already been taken by someone else. I see what you're saying, Shari. That makes a lot of sense.
Thank you so much. Alex and Shari, we really appreciate your insight.